Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the bullish scenario where we're looking for an impulsive structure to the upside, aiming for this wave 2 to finish somewhere inside this green box, which is the common target area for wave 2, sitting between the golden pocket 786 taken from the low to the high of 1, giving you a target area between 62.5k and 61.2k. The 886 is very rare for a wave 2, therefore never preferred, and we definitely don't want to hit the 886 here, sitting at 60.4k. Inside this wave 2, we are looking for a 3-wave corrective structure to the downside in a wave WXY, zigzag in wave W, complex WXY inside this wave X, and then inside this wave Y to the downside we either want to see a zigzag ABC, a flat structure 335, or a triangle which also starts with a 3-wave move. So preferably, this move to the downside is a 3-wave structure and not a 5-wave structure. So if we then zoom in to the 15-minute time frame, what we are aiming for in that bullish scenario is counting this as an ABC to the downside. Now finished A, finished B, looking for wave C, where currently you can see I have the white count on my chart, 1, 2, 3, 4, 5. But what is not ideal is this wave 4 here. An invalidation for wave 4 is the 0.618 taken from the high of 2 to the low of 3. And even though we didn't hit it by pretty much a few dollars, the probabilities that this over here is a wave 4 are not great because we did almost hit the 618 and it's very, very high. The common target area for wave 4 taken from the high of 2 to the low of 3 is the 0.236 to the 0.5 Fibonacci, as you can see over here, and the 618 is an invalidation. We didn't exactly hit it, but we got very, very close. So it does increase the probabilities that what we have to the downside at the moment is still wave 3 potential, where we then have to move the numbers to the right, and we're going to be looking for a lower C. Now the thing with looking for a lower wave C, however, is that we already crossed the pretty much final common target for a wave C, which is the 1.618 taken from the high to the low of A to the high of this wave B. The 1.618 here is a common target area for wave C. We are pretty much ranging here still, right, as you can see as well, but you don't really want to go too deep and move towards the 2.618 and even further and further and further, because then the probabilities increase for a bigger wave 3 to the downside instead of a wave C, which increases probabilities for the bearish scenarios and not the bullish scenario. Now talking about more bearish scenarios where price is going to take this low sooner or later, the first scenario here is a bigger zigzag to the downside in a wave A in green, then look for a bounce in the wave B, and then a wave C to the downside to eventually take the low at 60k. Now here we then have a wave 1, 2, 3, sideways complex 4, and a wave 5. This wave 4 has an internal W being a flat, then we have X complex and Y being a zigzag, starting a new impulse to the downside to finish wave 5. This wave 4 ended just before the 4 fib time taken from the low of 1 to the end of this wave 2 here, and then put on top of the low of this wave 3, comparing to with wave 4, and this is perfectly fine for a wave 4, so that is no problem. Now in this scenario, what we're then looking for is price to move to the downside in a 5-wave structure. So this is the difference with the bullish scenario. Here we want to see a 1, 2, 3, 4 and a wave 5 to the downside instead of a 3-wave structure. Now that means that locally we are still looking for a range to form quite similar to wave 2, 1, 2, eventually 3, 4, 5, and most commonly wave 4 is longer in time than wave 2, but as you can see during this move to the downside, there's not been a range, the length in time of the range we had over here for a wave 2, right? So as long as price is moving to the downside and we don't have a range at least similar to this range over here, we're just going to be looking for price to move down, and that is pretty much what I want to explain here on the 15-minute chart, right? We're looking for a wave 1, 2, and eventually a move to the downside. Now we can't label this a 3, 4, 5 because we have overlap then between a wave 1 and a wave 4. If we would say 1, 2, 3, 4, working on a wave 5, overlap here not allowed in an impulse to the downside unless we talk about diagonals, but that is not really what we're talking about at the moment. So therefore, we're looking at a 1, 2, and still a wave 3 to the downside, waiting for this wave 4 to form which should be the same length in time as this wave 2, as most commonly as mentioned, wave 4 is longer in time than wave 2. So pretty much as long as you don't see a range the size of 2, we're looking for price to move down. That therefore also means that the fibs on the chart here are going to move to the downside, because these fibs are the common target area for a wave 4 taken from the high of 2 to the low of wave 3. And as long as price is moving towards the downside, these fibs are going to move to the downside as well, because we are waiting for that range to form. Now if price is moving towards the upside without forming a range quite similar to this wave 2, so it moves to the upside over here and hits the 618, then it invalidates a wave 4 and we can be looking for price to move towards the upside, right? But as long as we don't actually see the 618 hit and we don't see a range similar in size of 2, we're going to be looking for price to move towards the downside. The most bearish scenario, however, is to not have a wave A bounce in B and a wave C. It is a direct move towards the downside, towards the lows here in a bigger three-wave structure, ABC or a WXY. Now I personally prefer the WXY here for a double zigzag for one main reason, which is the move here. So in an ABC we have a 1, 2, 3, 4, 5, okay fine, and then you have a WX and a wave Y. However, in a sideways double combo, if wave W is a zigzag, wave Y is not allowed to be a zigzag, only a triangle or a flat structure, but wave Y clearly here is not a flat and also not a triangle, while wave W is clearly not a flat, because W can only be a flat or a zigzag. So therefore I don't like to count this as a WXY. Doesn't really follow the rules from an Elliott Wave perspective, so I like to remove that ABC and then leave with the WXY, where we have a wave W zigzag, WXY and X, and then we look for a bigger wave Y to the downside, where this move could be a 5-wave structure in an internal wave A, look for a B, and then a wave C to the downside to finish Y, because now we're looking for a double zigzag to the downside, WXY double zigzag move, where then you are taking the low over here. Now looking at the CVD divergences, with this low we do have bullish CVD divergences. However, the local CVD divergences are most important, and what we have been seeing while price is moving to the downside are these 3-minute bearish CVD divergences, and I recommend to keep an eye on these CVD divergences on the 3-minute time frame and not zoom out to the 1 hour. So what you see here is price is moving down, right? And this is your high, the red candle here, but look at CVD, price moving down, look at blue here, higher highs on the CVD, right, compared to what the high is here, higher high on the CVD, lower price action, right, price moving down, CVD moving up. Bearish CVD divergences, same here as well, lower high on price, look at yellow, higher high on the CVD, which is a bearish CVD divergence, and arguably as we speak we are creating a red candle. CVD is moving up, that's an in-candle bearish CVD. It's not yet a closed candle, but you know, it is something that we have to keep in mind. So even though on a 1 hour time frame you will be able to spot this, where on the 1 hour we look like higher low in price, lower low on the CVD, bullish CVD divergences, the 3-minute CVD divergences are priority, right? The local CVD divergences are more important than the higher time frame CVD divergences, and as long as price also locally is creating bearish CVD divergences with every little bounce, we just look for price to move towards the downside. So if we then talk about the probabilities of the different scenarios, I actually don't really want to talk necessarily about all the scenarios here. I just want to talk about this bit. That is most important, the local move to the downsides. So on the 1 hour here, local probabilities over here for more downside are higher at the moment. We also touched the local 886, but that was actually just before we started recording that we had this move to the upside, move down, 886 touch and price move towards the upside. Now we already took the low, but an 886 is a rare target for 2, common for B or wave X, increasing probabilities to take the low here, which we have now done, of course, as you can see, right? So yeah, probabilities back to the 1 hour time frame are higher to move towards the downside. Now, as long as price moves down and doesn't create a range, the length of micro 2, which is what we have over here for an impulse, 1, 2, 3, sideways, 4, 5, or price to hit the 618, we simply look for price to move towards the downside. These are the two things that we are looking for now. As long as price is moving to the downside and we have a bit of volume coming in, we just let price do its thing. We have to wait for a range to form. As long as we do not get a range for a potential wave 4, 1, 2, 3, 4, and then expect one more drop in a 5, or have price move towards the upside and hit the 618, which is taken from this high to the low, or wherever the low is going to be if price moves down, we simply look for price to move towards the downside, right? So we just wait for some proof of support, wait for the range, wait for price to hit the 618, and then we take it from there, because at the moment probabilities are higher to move down as long as we do not have a range or did not hit that 618 from this high to the low. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.